Good morning, ladies and gentlemen. Well, not much change in the risk dial. 86, very strong. 86 is a very, very good score. If we have a look, all last week it was 86, 89 last Friday. All I can say is that all the spreads are going in one direction, favoring equities, and there's no change in that. At some stage there might be, and we will examine where the possible top might be. But I think my advice, which has been let it run and only buy free protection, is vindicated, and I think it will continue for quite some time. We will examine all the levels, but I think in the end equities are going to be just fine, and the rotation higher will eventually continue. Beyond these levels, I see nothing at all in the spreads to stop it. The weekly has quite some room to run. We could get really into the 90s with these MAs, indicating that we still have quite some time before it's time to turn bearish on equities. I think we are neither close in price nor in time to an absolute top. The indications from the yield curve continue to suggest a modest flattening of the yield curve. This is the 2s, 10s. As long as it stays below this 126, 127 level, the odds are that we go somewhere here around 106 to 99. So around the 100 mark. That is normalization, that is a continuation of this trend, which favors basically what is happening is that the inflation that we were so afraid of is being taken out of the market, and we are saying that the Fed is right. Inflation is transitory, but that does not mean that we don't have a yield curve. And that does not mean that the Fed does not do its tapering, and that does not mean that the Fed does not start hiking rates and normalizing situation over the course of the next 24 months. That tends to flatten the yield curve and tends to make sure that high growth equities perform better than value equities. That is bullish for the Nasdaq, and therefore we have a situation whereby the yield curve continues to flatten in all tenures, and as long as that continues, I just cannot see how the equity market is going to be in any trouble anytime soon. The 530s continues to go sideways, which is what I expected to do now. You can see how long it went sideways. What was that? 2.5 years, best part of. Why should it not go sideways for a bit here? I think anything between 124 and 105 is where it'll probably trade for the next 2 or 3 weeks. And that is good. That kind of level for the yield curve, 124, 105 basis points between 530s, is healthy. It's indicating an economy which is working, an economy which requires a normalized yield curve. And as long as that continues, the yield curve is not showing you any signs of danger. These were the signs of danger. At 154, we picked the level, it didn't go through it, it came back, and now it's a normal yield curve. As long as this continues, and I would have thought the point of danger is going to be here 140, well, I will fight it. I'm not going to fight it 124, I don't think there's enough in it. 140, I definitely start fighting it, and looking for the flattening all the way to 105. An early warning that something is reversing is going to be given by the 10s, 30s. I think any close down, back down through 64, 65 basis points on a weekly is going to be saying that the market is now more worried about inflation. That's going to be my first sign, my first indicator that maybe high tech is not going to be as bullish as all that, and that to expect some kind of rotation out of it. But as long as we hold minus 64.5 basis points on a daily and weekly basis, especially, I just don't think that there's any indicator of that. All that seems to be going on, and we will examine that later, is rotation, rotation, rotation out of Europe, out of Japan into the US, from one sector from value to growth, and that is pushing and pulling the SPX to certain levels. The yield curve has warned us beautifully that that the trend to the market is going to be to high tech and growth stocks is going to be up. As soon as we broke through here, that was your buy signal for high growth, and don't stand in the way of the market going higher. If it reverses, I think minus 64.5 now is going to be very important. If that reverses down through, and we certainly could have a period of that, that will be a signal to get out of tech. At the moment, blue skies. In the outrights, you can see how boring the 5-year has become. And that is all good and well. I still think that the trend longer term is towards this 112 level in terms of yield. Don't forget, in August we will have the Fed meeting, or not a meeting, but the Jackson Hole conference. There will be speculation that there at that conference they announce how they're going to do the tapering and how they're going to do the tightening and the conditions for all those. So I think it's terribly unlikely that we do much better than we have been doing in the shorter tenures. I think all dips in the short tenures will be bought for a move back up towards the highs in before the Jackson Hole conference. I very much doubt that we will trade much below 80 basis points in the 5-year in the foreseeable future. Anything underneath here, I'm a buyer of yield, and basically buyer of put spreads in the futures, because I think that by Jackson Hole we will be pushing these highs. And you can see how boring the 10s have become. Basically, they've backed off from the lots and lots of inflation to moderate inflation. I doubt very much that we go through a lot of through this 139 level. I think we have the 200-day moving average coming up. I think any move below it by a few basis points, something to around 130 or so, is going to be well bought and well supported. We certainly are in a period of modestly declining rates in the 10-year. That is flat. That is what is flattening the curve, but I don't think it goes very far. And around these levels, it'll be a good opportunity to buy some yield. But I think the 10s and the 30s, which I'll show you next here, are going to be very boring. We're doing really is we're getting rid of the anxiety that we had, and that anxiety basically says that we are back to the same yields that we were back in the early part of 2020, and that basically says to me that TLT is going to be between 137 and say 146, 147 for quite some time. Something like this, and then at some stage we will be worried about Jackson Hole, and we will go back to 220 or something like that, this kind of level, 218, 217. that is all that's going on. I don't think there's, nobody's expecting deflation, and therefore I certainly don't see the 30-year through 190. If we go through there and stay through there, there's definitely something going on. But I don't think that's happening. All that's happening is that people are saying that they're happy to invest, in the longer tenures because they don't think inflation is going to be as bad. Well, is it going to be much better than people expect? Probably not. And therefore, a sustained period of trading between 190 and 220, I think, is in order. In Europe too, the trend is for a flattening yield curve. This is the bubble. And, would it surprise me if the bubble traded down here to minus 64, minus 65? No, not really. But the bubble on the downside has very little. I mean, whether we stop at minus 65 or we stop here at minus 68, that is the only question. There will be reverses in bubble for sure. The bubble is the least attractive and probably the safest one to short at levels. Certainly when it gets to here, I will short the hell out of the futures. If we look at the tens, the Bund, that is more dangerous to short because it could easily do an ABC down to this kind of level, minus 37, minus 38, where it's in itself there is going to be a wonderful opportunity to short the futures. But you can see how this pattern could easily be an ABC down here in the tens. But if we go back to the fives, and here it is in the bubble, it could easily be a flat and stop around here. Absolutely no reason to be long of bubbles at those levels. The bubble will have discounted all the better inflation already has, I think. But I think when it gets down to these levels, it's going to be an absolutely wonderful short, and that is what I'm looking to do next. The Bund, I think, can easily run into this kind of area around the minus 37, minus 38. So it's certainly not something that I want to be short of now, but it's obvious to me that at some stage the both Bunds and bubbles, once they've reached these targets, are going to be wonderful opportunities to short again, short the futures, because I think before Jackson Hole or into Jackson Hole, we have a bit of a mare in both Bunds and bubbles, and led by the US. If we have a look at the differential between 10 years US and 10-year Germany, we see that is very much stable at the moment. I certainly expect it to remain in this corridor between 175 and around 153. I really don't see much movement in this, which tells me that my analysis in Bunds and bubbles is correct. At some stage, you want to start fighting it, and those were the levels that I just showed you. The BTPs show me that there is a considerable danger that we fall in the Bunds to that minus 38 area. And that is because this is obviously going to be some kind of an ABC which could go all the way down to this 56, 55 area. The BTPs are bid simply because whenever the curves retrace and whenever the outrights retrace, there is a search for yield, and the BTPs give you yield, a positive yield, as opposed to the Bunds, which give you a negative yield. If we have a look at what the differential, this is Bunds against BTPs, you can see that while everybody was getting bearish in Europe and we got to the minus 120 level, that was my target, BTPs were underperforming the Bund, and now they're outperforming the Bund. We could easily go back down to this 92, 93 area. That gives the opportunity for everything to unwind, and then we can go back up. So we're going in waves in the BTPs. The BTPs are very good indicators, I think. Go back to there. I'm looking for this kind of level, and I think if we get down to here around the 60 basis points to 55 basis points, it's going to be a great short in BTPs looking into August and Jackson Hole. You're not going to see me get very excited about the dollar. What are my thoughts? My thoughts are that a market which basically moves, in 4 days we went up, and in one day we gave up half those gains, is really not worth thinking that hard about. It's overbought on the dailies, but basically who cares? Could it come back to 91.40? Very easily could it. It will, and probably will come back to 91.40. But the odds of it breaking 91.01, which is the important weekly level to me, are not that great. In fact, I would have thought they're very low. Why? Because as Jackson Hole approaches, and we are, 6 weeks, 7 weeks away from it, there will be a tendency to look for a slightly stronger dollar, because nobody wants to be caught out by a central bank that is raising rates more aggressively than people might fear relative to others. And therefore, I can't see the dollar being very offered or sold hard into Jackson Hole. I think the odds are that any dip down to 91.01 or even 91.41, or between the two, is going to be bought for a move up to the 93.14. I certainly expect the dollar to be stronger than this when Jackson Hole starts, simply because the market will be afraid of something coming, a stronger statement coming out of the Fed. Euro USD, much the same pattern. I think any time it pushes to this 119.88, 120 level, they're going to be good sellers. And my target is to see it come down to this 115.20 area, 115.40 area, just to stop all these people out. This kind of area, I think, is going to be attempted before Jackson Hole, and then we'll probably go into Jackson Hole somewhere around here, 116, 117, that kind of thing, having stopped everybody out down here who was afraid of it. That's just my potential. I think, that eventually I think the dollar will be weaker, because I just can't see how the US economy is going to outperform massively during a period of growth. So I really am looking to basically sell around 119.80 and buy anywhere just short of 115. I think that is the range now for the next 6-7 weeks before Jackson Hole. Well, if I'm looking for yields to be relatively stable with very minor movements in the yield curve, and overall for the short end to fear Jackson Hole, I can't really be all that excited about gold. If I think that the dollar is going to range, but overall maybe be slightly higher than this going into it, then I really can't get very excited about gold. The fact that, if we examine the price action of the past couple of weeks, it got right down to 1764, and then all rally attempts have been, quite pathetic. We really haven't been able to break through 117.95. I said, I fortunately took profits in right there, and then he came down. It stopped everybody out, but basically reversed. It's doing nothing, much like I expect the overall yields to do nothing. And this 200-day moving average keeps on turning, keeps on turning, keeps on turning. Unless we start breaking 118.30 very quickly, I really don't see that there is much to look forward for the next 6 or 7 weeks in gold. At some stage, before Jackson Hole, they will probably do a real stop run down into the 1700s, and that's going to be low 1700s, and that's going to be a wonderful buying opportunity. So that is really all I can say about gold. The upside looks very unappealing and unexciting at the moment. The market action is very unappealing and unexciting, and that tells me that the upside is limited to maybe some stops above 1800 just to stop people out, get them bullish, and then straight back down. I really would not be a big buyer of gold at these levels. Certainly for nothing else than a small trade. I really do want it to come down and test these kind of levels around the low 1700s, high 1600s. I think that's going to be a wonderful opportunity. Jackson Hole is going to make everybody fear something. Some people will be afraid of nothing, and some people will be afraid of too much tightening. So really, I think there will be opportunities both ways of people getting squeezed out one way or another. But I really would love to see these levels to have lots of call spreads on board. This surrounds us, this 1700 level, this retracement. And as you can see, it's a 50% retracement of this whole move is around 1688. See it again. That's the kind of level that I would love to see. Before anybody gets too bearish of gold, I just wanted to show you this is SPY over GLD, and this is AIU, but I could have chosen GLD. There's no difference over TLT. You can see that gold is holding its own against bonds, very well indeed. It's above this 0.2162, which has been basically a swing level that indicates changes in macro relationships. And it's only now here in gold is, or the SPY is making new highs against gold all the way since mid 2018. So, anybody who's been underweight gold throughout this period is only now starting to see a little bit of satisfaction. Can this move higher? Well, of course it can. The trend ever since 2009, 2010, and we can actually enlarge this chart to show you where we are. We are only now coming back to these levels where we were in 2000 and 2006. So really gold has not performed very badly at all over the past couple of decades, and I think will continue to perform on a par with historical performance. We are getting to levels up here where gold could easily be something to overweigh in a couple of years' time. But you can see this relationship, how it's traded over the past, what was this, 15 years. Well, we're only now coming to levels where gold is going to be truly attractive even against equities. I wanted to just very quickly show you in deviations that we are in the red for SPY, and I expected basically to do something like this or like that. At some stage we will come back and retest these levels just like we did here, but I don't expect it to be anything but a retest. You can see if you examine the individual sectors that we are being driven basically by XLK, and the likelihood of XLK coming down very much more than 3, 4, 5% and testing these kind of levels is quite low, as we'll see from NQ later on. So really, sideways to at some stage down quite hard, except ahead of the Jackson Hole, just on fears of what might happen, is probably the favored. I think XLF, when if he does an ABC and he comes down to these kind of levels, what's that, just below 35, around the 34, 33 level, is going to be probably an excellent buy at some stage, because there will be a bit of a panic ahead of Jackson Hole, and I would love to buy an ABC down to this kind of level, 33 to 34 area. I think there's definitely one move higher in XLF before it's all over. SPX is looking toppy in all time frames, but that doesn't mean that it's a short. It just means that it could go sideways. Now this is on the 195 minute. I think that Monday, Tuesday, we come back to this kind of level at the very least. What's that, 93.18? That, with a basis 10 in futures, that will just give you slightly north of 4,300. But I think the situation is quite simple. On the 195 minutes, we have very clear levels at 42.90 now. And as long as the market doesn't trade through 42.90, all it's doing is building up strength for a move further up. On the dailies, we are through the daily Bollinger Bands, which tells me that at some stage we do come down towards the 42.90 level. But on the dailies, as long as 42.55 to 42.32 holds, we are in clover. We're doing nothing wrong, absolutely nothing wrong. And on the weeklies, really 42.32 is the level. As long as we stay above 42.32, we are not in trouble in any way. You have to respect what price action is telling you. Price action is telling you that we are still grinding higher. We are very overbought, but that doesn't mean that you short. That means you just get less long. You just let the market have some certain percentage of your long portfolio and wait for it to dip. And if it doesn't, then you're wrong and you have to buy it a little bit higher. But the odds now definitely are that it will go and test these levels which I've just mentioned. I would be very surprised if at some stage next week we don't test 42.90 again, which is going to be a wonderful buy. We saw just now how basically the market is SPY is being driven by its largest sector, which is tech, and how tech is being driven by the flattening of the yield curve and the fact that we've taken out all the excessive fear of inflation out of the 30s. Well, if that is coming to an end, probably the outperformance of tech is not very far from coming to an end. We can see how on the weeklies we are through the Bollinger Bands, and we can see how it's never been a good thing to be through the Bollinger Bands. Throughout this history, every time we went through the Bollinger Bands, it might have stayed there for a week, it might have stayed there for 2, but eventually it came back hard. No reason not to expect the same thing to happen again here. To me, 14,070, 14,044 are the levels. This is no longer relevant and can basically go away. We are basically wedging up here, so what? But I definitely expect that at some stage the Nasdaq comes back, high tech comes back as the yield curve at some stage pulls back, and we have a higher yield regime briefly going into middle of August, late August, when Jackson Hole takes place. So I really don't expect NASDAQ to keep outperforming very much here. And that to me is probably the message to take away. At some stage, get rid of your high yielders in the next couple of weeks, because I have this feeling that before Jackson Hole, we will retest this 14,000 kind of area, and that's probably going to be a wonderful buy, but I think a retest there will be, and that is going to be what actually takes out all the overboughtness of the market out. And here we are in the tech spreads. This is XLF over XLK, and I'll enlarge it for you. I would have thought that if it comes back a little bit more, it's going to be a decent buy. And I think at some stage, you definitely want to rotate somewhere around here. You want to rotate out of XLK into XLF, looking for that Jackson Hole kind of move, which will favor XLF. This is the cues against SPY. I would have thought, can it go up to here? Absolutely, but that is only like a couple of percentage points of outperformance, and then at some stage, as we approach the middle of August, it'll come back. That is the kind of stuff that I'm looking for, and this is the NASDAQ against the Dow. I think these levels are going to be very hard to break. When we get to these highs in the next week or so, you definitely want to rotate out of these high techs because they're very overbought, and the risk reward becomes that it comes straight back down, simply because, as I keep on repeating, yields at some stage will go higher in anticipation of what the Fed might do. Nikkei continues to intrigue me, and I think that we are quite close to a very interesting longer term trade. I've done a daily chart and a weekly chart next to each other just for clarity. It's amazing. I mean, these lines have been in for forever. I haven't changed them. I haven't put them in now. These are basically trend lines which have been in for years and years and years, going back to these, going back all the way to, I think, 2015 or something like that. And it still seems to trade within them extremely well. So don't forget, this is the daily chart, and we are coming up to the 200-day moving average here, 27.5, and this amazing trend line here. You see how many highs and lows it keeps on catching. As you know, I was a great fan of Nikkei throughout last year, and now that the market has basically stalled sideways, I'm looking for an opportunity to get back in at very interesting levels. 26,910 is going to be a very interesting level, as is 28,335. The fact that Nikkei is just going sideways, sideways, sideways is telling me, and we can have a look at that on the weekly basis, is telling me that it will be the leader of the next wave higher in equities, whenever that might happen. It could be 6 months away, it could be, who knows. But when that happens, I think the Nikkei will lead it, and nobody will understand what is going on, and it'll one day just wake up above 30,200 and probably reach 40,000 in 1 month. It's going to be that kind of a move. But in the meantime, I think every time it comes down, and it could easily come down into the 26,000s, that is going to be a wonderful opportunity. Naturally, I will tweet all my thoughts, but what you have to understand is the relationship to SPY. Now, this is SPY over EWJ, and this has been basically going on. This trend line is all the way back up to 2008, and you can see that basically the market has been in that uptrend throughout throughout basically 12-13 years. This level here is the previous high, and it's interesting to go and see how many highs and lows that level has caught, and this takes you all the way back to 2002. So you can see that when it touched it in 2012, it respected it, and when it finally broke it, it stayed above it all throughout 2014 and 2015, and now it is finally outside of this trend line and channel. I think that we are very close to having to say that Nikkei is a much better risk reward than SPY. And basically any drop in Nikkei I shall be looking for as an opportunity to get long of it, because it just telling me that I should rotate my longer term money out of the US into Japan. Certainly, maybe this has got another couple of weeks of getting worse. Don't get me wrong, I'm not saying something that you have to do on Monday morning or even Tuesday, since Monday's a holiday, but certainly that is the way you should look at it. This is a perfect trend channel. It has held for 15 years just about, and it would be stupid to ignore its warning. The DAX I would leave alone. Again, these trend lines have been drawn in for, many, many years. It's just respected them so nicely, isn't it? I'm always amazed. To me, the dangers in Europe and in Japan to a certain extent are that people are buying them simply because they see SPY going up, and at some stage they all get stopped out. Every time people keep on buying things because something else is going up, that to me is an accident waiting to happen. And we could easily have a quick move down in both Nikkei and DAX, which then is very quickly reversed, and we have again leadership from the Nikkei and from the DAX. But I'm beginning to think that we need a little bit of an accident first, simply because people are mindlessly buying them just because SPY is going up. You can see that on a monthly basis we are very much within this uptrend line that basically what I was looking for. When we were breaking here, the 3,700, 3,800, and I said we would go and test these lines, nobody really believed me. And then when I now say that we could have a little bit of an accident, come back down towards 3,700 before we go again and touch 4,500, everyone is skeptical, which tells me that the fact that Europe and Japan don't want to know about the upside for the last couple of weeks, why SPY has been going up, means that people are getting irrationally long of them at these levels, and we probably need a little bit of an accident before we can replenish our engines and go higher. This is what I'm looking for in terms of levels. These are your warning levels. I'm not saying you should be short of either of these contracts. I'm just saying that if you see the stocks below 39.86, and if you see a daily close below 15,457 in the in the DAX, you have your warnings. You know, you have been warned that the price action is telling you something. So, am I bullish for both of these longer term? Yes, I am. But I think that the odds, funnily enough, of an accident happening here, while the SPX only retraces to the levels that I mentioned earlier, are quite high. And that will be the opportunity to buy them and buy the Nikkei. I have posted all the levels. I haven't changed very much because there is not very much to change in the bonds. To me, next week or so, we continue slowly the yield curve flattening, but at some stage between now and Jackson Hole, we will see all yields move higher, especially at the short end. Um, all the levels in the equities are here really until we see 42.90 give way, and then 42.55. There is not a lot going on in SPX. To me, these levels here in stocks and DAX are more actual and more important, because they will it would be the height of the market being the market stop out all the people who have been buying stocks and DAX just because SPY is going up and stocks and DAX looks cheap. So that to me is going to be the warning, and if that happens, I would have thought that stocks and SPX then test these levels. But I don't think those levels give way, simply because I cannot see 14,000 giving way in NQ anytime soon. And that to me says that the US is still in an uptrend, but that these will be great buys when they reach some sort of an exhaustion. And we'll talk about that, and I'll definitely tweet to you when I think that is happening. Have a wonderful Independence Day. Many congratulations on your holiday, and I will actually tweet you on Tuesday.